All right, hey guys, hey, it's Josh here with Stanek Insurance, and in this little short video, I'm going to talk about 10 things what you can do with Index Universal Life, and I'm going to keep it really simple right here. I just made a little thing on Notepad right here, but I wrote on the top here, as you can see here, Index Universal Life. Two companies that I represent. Obviously, I represent more than that. I have 15, 20 different carriers. But for Index Universal Life, I really, my go-to companies, again, it depends on the person, health situation. But Securian, which is Minnesota Life, and then also North American. And what you want to do is, here's number one, agent's commission on these products, 55 to 100%. And what you'll see a lot of times is they're doing the old school, the whole life products. And whole life, again, it has its time and place in a portfolio, but it's 55 to 100% commission depending on the structure of it. Where I like to do, again, it comes down to the second one right here, the policy design. A good agent, a reputable agent, is going to look at, obviously, at your situation and say, okay, what are you looking to accomplish? They're going to take that death benefit. They're going to try to minimize your death benefit and try to give you more cash value accumulation, which is right here in the third line. So low death benefit with a high cash value accumulation. And then once you do that, you're going to cut down, you go up to line number one here, you're going to cut down your commission, because the commission's based on right here on your death benefit. When you have those huge commissions in the life insurance industry, if you have a policy that's designed with a heavy maximization of a death benefit, that's where you see these big commissions. Now, to get away from those commission structures, high commission structures, what you do is you try to lower the death benefit, and then you overfund it with cash value. And that comes down to the policy design. And that's the power, that's the control what an individual agent has. But what can IUL do here? Tax-deferred growth. All the money that's in this policy grows tax-deferred, which means you don't pay taxes on it year in, year out. And then if you want to take the money out, depending on what age, you can obviously take tax-free loans. And that's based obviously on the interest rate from the insurance company. You can take out tax-free loans, and you can do a wash loan, because when you take out money from a policy, the money's still growing. The cash value in the policy is still growing. It's still credited based on what the market's doing. So you could have a wash loan. For example, let's say the insurance company is lending money. They're going to borrow money to you at 4 or 5%. You can your policy could be growing at 4 to 5%, so it could be a wash loan. And these are loans that never have to be paid back. Again, you don't want to get to the point where obviously the policy doesn't cannibalize itself, it doesn't blow up. Just be careful on that. But these are tax-free loans, meaning pretty powerful stuff. You're never going to have to pay, obviously, taxes on that. Where is this applicable? When we talk about Index Universal Life, you know, I look at a situation, again, you got to have a little bit of money. If you don't, life's a little tough. But I look at, if you got a 401k and you're participating, doing a company match, you have an IRA, have your Roth IRA, and then you look at doing an overfunded IUL, not your grandma, grandpa, your old school whole life product that a lot of those products just don't get it done. So you want to have one that's overfunded IUL. But it kind of mirrors an IRA. So if you look at the construct of an IRA, it's after-tax contributions. Okay, an IRA is after-tax contributions. It grows tax-deferred, and then the money comes out tax-free. An overfunded IUL, similar construct. Again, after-tax contributions. It grows tax-deferred. It can also come out tax-free. Now, the benefit here is it has a life insurance benefit attached to it. Again, the fees are a little bit higher than an IRA, because typically what you want to put in an IRA, again, you can stuff in an IRA pretty much anything: mutual fund, stock, ETF, UIT, Unit Investment Trust. But when you're looking at an IUL, you want to look at a product that has no caps. And that's why I like the Secure Minnesota Life. You're in the market and there's no cap. So let's say the market, well, as of today is 310. Futures are way up. But yesterday lost 2,200. But you want to have a position where there's no caps, meaning, let's say in a year the S&P 500 does 15%. A lot of these products will cap you at 6, 7, 8%. You want to have a product that has no caps, which means if the S&P 500 does 15%, you get that true 15%, and that's credited to your cash value. And again, on life insurance, creditor protection, meaning the business owner, let's say you get sued. I mean, it does happen. We live in a a very legal society. People like to sue. But this is creditor proof, which means they cannot take your assets. And then also right here, if you're looking down the road, and again, this is tough. It's tough. But this is the benefit of a fiduciary, of a planner, of a person that can think ahead. But with the Pension Protection Act of 2006, which actually rolled out in 2010, you can take actually the cash value proceeds. Let's say you have accumulation cash value, and you can roll that in and you can make that applicable for long-term care benefits. And you can do that tax-free. And again, it's flexible. You have a lot of different options. But that's something, obviously you're not going to be thinking about it. Well, you might be thinking about it at 25, 30, 35, 40. But that's just an option when you start accumulating assets. You have options. When you have options, that's when you become dangerous. When you become dangerous in a good way, meaning you have options and you can do more creative things with your monies and with estate planning. And then also, I'm not big on putting a lot of different riders on insurance policies. I'm just not. You get into unnecessary fees. You slow down the growth of a policy. But in this case, I do like to waiver a premium. In case of disability, the premium will be paid. And for that, there's a little, obviously it does slow down the growth of a policy a little bit, but the waiver of premium on a policy can help you in the case of disability. It can keep funding the policy and keep that growth going. So that's my take on Index Universal Life. Again, Secure Minnesota Life, North American, those are the two products that I like. And again, I went through a number of different carriers, and there's some good carriers out there as well. But these are the two I think that serve my client base and accomplish what they want to get done. For more information, StanicSeniorBenefits.com. Until the next video, keep it locked, loaded right here. StanicSeniorBenefits.com.